Good afternoon and namaste, ladies and gentlemen. Welcome to Business Today's very special show, Market Gurus, where you get to meet the finest brains on Dalal Street, professionals and individuals who have managed the bull and the bear markets over the last 20-25 years and have created immense wealth for their shareholders, for their unit holders, for their customers. We welcome today Mr. Sandip Bansal, Deputy Chief Investment Officer at ASK Investment Managers. Mr. Bansal has previously worked with SBI Life Insurance and has a very deep background in institutional research. He's worked with UBS and Kotak Institutional. Sandip ji manages 30,000 crore rupees in PMS and AIF and has done a fantastic job in managing expectations and creating long-term wealth. Namaste, Mr. Bansal, a very warm welcome to you. How do you see sentiment on Dalal Street these days? Is there hope for Nifty bulls seeing the last 4 days of performance versus the last 6 months?
So namaste, Shailendra-ji. Thank you so much for having me on the show. Shailendra, the market is driven by multiple factors. There are sentiments, there is liquidity, both of which in today's context are on the negative side. Sentiments because of whatever is happening globally for emerging markets especially, there is this threat of tariffs, because of which money is moving back to the US from an equity market perspective. Also, FII selling has led to has been ferocious, especially in the last few months. So these two things are negative. But if we look at the fundamentals of the economy, we believe that at the margin things are only improving. If we look at the first half of this financial year, FY25, earnings were disappointing. In Q3, the earnings have been broadly in line with expectations. Obviously, there have been pockets of disappointments, but largely in line. Given the various measures that have been taken by RBI, either in terms of infusing liquidity, in terms of rate cut, or by the budget, in terms of boosting consumption, or by the government in terms of increasing spending on the capital side, in last few months, given the muted crude oil prices, etc., we believe that earnings are likely to pick up, and that, Shailendra, is going to be a positive for equity markets in our view. So yes, there is hope for sure.
Wonderful. Let us Sandeep ji, explore this hope. We've had about a 17-18% percentage point correction on the Nifty. Mid caps and small caps have been beaten black and blue. Where do you see this glimmer of hope? Where would ASK investment managers deploy their fresh cash that they are raising from clients?
So Shailendra, one way of looking at investments is through this lens of market caps. We have a approach which is more focused on bottom-up business character. So we focus on earnings, cash flows, growth of those earnings, robustness of those earnings, return on capital, etc., etc. We believe that wherever there is a solid quality of business and there is earnings delivery, those businesses and hence stock prices are likely to perform well, irrespective of whether it is large cap, mid cap, or small cap. Having said that, yes, in today's market, given the ferocity of the selling that we've seen, the impact has been relatively more on the mid cap and small cap side. Over there, we would like to believe that there are pockets where valuation excesses have been corrected, and on a bottom-up basis, stocks are looking attractive. Large cap as a basket, if we were to talk in terms of market cap terms, are they as a basket more attractively valued? The answer to that is yes. But our incremental money deployment is going to be more on a stock specific and bottom up basis rather than a market cap basis. Having said that, a larger proportion of our AUM would currently be deployed in large caps.
Fair point. You manage about 30,000 crore rupees in PMS and AIF funds, and you say they are tilted more towards large caps. Uh, Sandeep ji, when we look at the broader view of Dalal Street, there has been, as you point out, that Q3 earnings by and large have been fairly in line with expectations. How do you see Q4 and the subsequent first and second quarters for corporate India? Is there cause for worry because of stock prices being still inflated, or is there cause for worry that earnings growth will not materialize? What is a bigger fear in your mind?
Sure. So, if we look at going forward from here, Shailendra, what is likely is that whatever measures have been taken, let's say by the RBI, in terms of easing liquidity, that will start to flow through the economy. Okay. Obviously, it will have an impact with a slight lag. The tax cut benefits that have been given in the budget, that will start to benefit consumption more in FY26. So that is going to be after Q4 of this year, and more likely the impact is going to be seen towards or from the end of the first quarter onwards next year.
Yes.
But if we look at the things that are working currently, so government spending has picked up, especially on the capital side. That should aid the pickup in the economy. Generally speaking, the first quarter of the calendar year and the next quarter of the calendar year are strong periods of construction activity in the country. And hence, there is a lot of economic activity on the ground. What we would also like to believe that a lot of the decision making at the government's end, in terms of project ordering, project execution, release of payments, all of that which might have been impacted last year because of first the general elections and then maybe because of a few state elections, those things are no longer going to be there now, and that process should be likely to be speeded up, which is again likely to support growth in the coming quarters as well. Also, the coming down of inflation should help wallets. Crude prices have also been lowered, so that should also play a role in margins. All of that obviously is going to come up with a slight lag. The only one caution, however, Shailendra, would be that the global environment is relatively cautious in today's time because of tariffs environment. We really don't know how the tariff story is going to exactly play out. And so to that extent, could there be an impact? The answer is yes, because obviously businesses do not like uncertainty.
Okay. With that background in mind, Sandeep ji, let us now analyze ASK Investment Managers portfolio. We are now at mid-March, and around September is when the market started to correct. In this phase, what is the percentage of cash towards 30,000 crore rupees, and how have you deployed this cash over the last maybe 2 weeks or so, if at all?
Sure. So, Shailendra, we do not generally take cash calls or market focused calls. Our investment style is largely bottom up and business based, and hence top down market based calls is something which we avoid. We generally overall remain invested at all points in time. Do market corrections or changes in market behavior make us do any changes in the portfolio? Sometimes yes, sometimes no. Obviously, because we are mostly invested at all points in time, we need to sell something to buy something. So in this market correction, have we made many large changes to the portfolio? The answer is no, because most of our businesses that we own we believe have the strength of balance sheet, strength of management, and earnings growth delivery. And hence, we largely remain convinced about the stories that we've invested in. Do we continue to make incremental changes based on market opportunities? The answer is yes. So, we currently do like businesses which are in the manufacturing space, businesses which are, aligned to the power capex spending in the country. We also like businesses in discretionary consumption, and we like businesses in the healthcare space.
Okay. When you look at the overall portfolio spread over 30,000 crore rupees, Sandip ji, has the number of stocks decreased in the last 6 months, or has it increased? Are you putting fresh money into existing positions, or have you added some new potentially strong candidates for the next 2 or 3 years?
So we would have added we've added stocks to our portfolio over the last few months, I would say. So the number of stocks in the portfolio would have increased a bit. But would it have been a big increase? The answer is no. I would say it would have been a marginal increase. The way we think about it is that as and when business new businesses come, or our understanding of those businesses improves, and they are available at a price point which in our view offers a margin of safety, we go ahead and invest in those businesses. We generally take a long-term view at the time of investments, and obviously in a long-term journey, Shailendra, there would be phases of market volatility, market violence. Many a time we would be understanding such movements. Many a times, when it is more sentiment, liquidity, etc. driven, we just have to tide them over and not necessarily react to such actions in the market.
Okay. Sandip ji, when you look at the disruption that the world is facing, both in terms of economic policy as also some part of it being politically weaponized, do you think we have stepped into a different world, and that fund managers such as you would have to have maybe a different set of skill sets, or will markets just ignore such maybe 2, 3, 4 year disruptions and then move apace?
So that's a great question, Shailendra. Firstly, I think the fundamentals of investing in terms of having a long-term focus and investing in solid businesses with good balance sheets, good quality of management, strong earnings growth, all of that I think fundamentally aren't likely to change. However, what could perhaps change, especially over the course of the next few years, is the fact that market volatility could increase based on a lot of geopolitical developments around tariffs, and development issues surrounding trade, etc. And hence, it will be very important for everyone to uh, keep a long-term view in mind and to manage emotions. It is obviously very easy to say, but very difficult to implement. I think that part is going to be quite challenging going forward. In such an environment, noise, news flow, and volatility, all of this is going to increase. If we react to them time and again, what is likely to be is that the case is that we are more likely to get hurt than benefit out of it. Having said that, I think our focus is going to remain on solid businesses and for long-term investing, but we will need to be conscious about changes in the macro and in the environment which are going to fundamentally alter the way business is done. So let's say if I am, just theoretically speaking, invested in a business which is, let's say, heavily dependent on exports to a particular geography, could its business completely alter? Such are the questions that we would need to evaluate very closely. Could AI have a big impact on, let's say some IT related businesses or some other businesses? So these are the deeper questions, business level impacts, which we will need to more closely evaluate. So yes, the work on our end is going to increase.
Well, that's very nice. Sandeep ji, for the benefit of our viewers, could you please describe maybe 4 or 5 characteristics of solid businesses in India? The reason why I ask you this is in the last 18 to 24 months, many so-called businesses have been disrupted very sharply. You know what I'm talking about, and that's mainly because they had such high gross margins that one would be really stupid not looking at those sectors which were maybe oligopolistic. But define solid businesses for us. How does ASK investment managers research team look at a solid business?
Sure. So, firstly, the quality of management should be very good. By quality of management, we mean that they should be having the interests of minority shareholders in mind. There should be a strong vision. There should be a lot of hunger and ambition, and then there should be a good execution track record, because all three are important ingredients in value creation. Obviously, it is the leadership that matters, and below that, a strong management team that is able to execute the plan which is laid out. In addition to that, for by quality, we also mean a good quality of balance sheet. We would not like businesses which have a lot of leverage. We would ideally want businesses to generate enough free cash so that they are able to fund their own growth, and they are not dependent either on equity capital markets or on debt markets for their growth. The third aspect should be that the opportunity in front of the business should be very large, and the growth profile of the business should be such that it is able to participate or benefit from this large opportunity. And for it to be able to benefit from that growth, it should have a strong competitive advantage. Otherwise, its market share would be taken away by someone else. And hence, it is important that the execution machinery of the business is very solid. So, for judging all of this, Shailendra, we look at the historical track records for the business as well. How have they performed in the past? For us, what also defines quality is the consistency of the earnings, the predictability of the earnings, and the relative certainty of the earnings. Obviously, every business operates in a very dynamic environment, and things do continuously change. But the ability of the business to anticipate and respond to various challenges that have occurred in the past gives us increased belief on the quality of a particular business.
Sandeep ji, I think this is one of the most precise definitions of a solid management and business that I have heard. Elaborate for our viewers what would be consistent, predictable, and certainty of earnings in terms of maybe 5-7 ratios that ASK investment managers looks into. What attracts you, and what sort of keeps you away?
Sure. So let's say if we were to look at a business wherein we believe that earnings could go up 100-200% in a particular year, and next year the earnings could go down by 30-40%, and then again go up the next year by 40-50%. One of the examples of businesses which typically depict such characteristics are maybe cyclical commodity driven businesses. So those are the kind of businesses where we would say that earnings are not very consistent. They are relatively more volatile. In such a case, earnings are also less predictable. In such a case, earnings are also less certain. So those are the businesses which would be very low down in terms of our preference. In such businesses, the relative destiny of the business is outside the business's locus of control, because the pricing in general, a large part of the pricing is influenced by the market. Uh, Businesses which have relative control on consistent, regular volume growth and profitable volume growth with a strong competitive advantages are able to deliver these predictable, consistent, and relative certain earnings. Also, the balance sheet plays an important part in this. If the business has a relatively high return on capital, it is able to fund its own growth. And that also makes a business more consistent, because then it is not dependent on external capital to achieve its own growth. And the return on capital of a business, in some extent, also is an indicator of the competitive advantage or the moat that the business employs. So, these are a few of the aspects that go into our evaluation of a particular business before investing.
Wonderful. Now let's come back to your portfolio. As you say, 30,000 crore rupees is deployed largely towards mid caps, and the number of stocks could have marginally increased. What is the total number of stocks that ASK Investment Managers has spread over 30,000 crore rupees?
So that number, in my view, would be less than 100,
Okay.
Shalin.
Okay, fine. And do all 100, of course, you won't buy anything which doesn't have solid management and a basic board. Do all 100 exhibit these characteristics by and large?
Yes, the answer to that would be yes, because we would be investing in businesses which we believe are leadership businesses, and leadership businesses would mostly be having these kind of characteristics. Otherwise, it will be difficult for them to maintain their leadership, to grow their leadership, and hence, yes, largely across businesses, these characteristics would be there.
Okay. And Sandeep I don't have a gentle way of asking this question. So let me phrase it as brutally as I can. Are we in a bear market?
So it doesn't seem so, Shailendra. So there are multiple aspects which go in a defining a market. So a bear market, in general terms, the way people define it is that if indices correct by, let's say, more than 20%, it is generally, colloquially or speaking, is taken to be a bear market. So maybe small cap indices have corrected by more than that. Mid cap indices have corrected by about those levels. Large cap indices are maybe down around 15% kind of so. Are today's sentiments really weak? The answer is yes. Is today liquidity weak because of FII selling? The answer to that is also yes. But fundamentally, is there a big crisis today? The answer to our mind as of now is that fundamentally there is no crisis. Is there business uncertainty globally because of this tariff situation? The answer to that is yes. And obviously, businesses would think twice before investing in such an environment. Having said that, if you look at Indian markets are generally largely a domestic demand driven market. Also, from these tariff wars that are currently being played out, India could perhaps actually be a net beneficiary, because we are not the largest trading partner of the US. In fact, we are likely the 10th largest trading partner of the US. And our trade relations are a fraction of some of the largest trading partners of the US, like Canada, Mexico, China, etc. So manufacturing, because the US would still need to consume, and it will not be possible for it to manufacture everything on its own, given the timelines involved, given the costs involved, and given the higher tariffs that would potentially be there on other countries. India could be a net beneficiary. Also, we believe that a lot of the growth pain is behind us. Last year, growth was impacted due to elections, due to tight systemic liquidity. because of the macro-prudential measures that had been rightly perhaps taken by the central bank. And now all of those things have already started to alter. We've seen rate cut. We've seen systemic liquidity increase by RBI. We've seen a good budget. We've seen government spending pick up. And all of these things, in our view, are likely to aid growth going forward. Also, the base of earnings growth is low. So in FY25, our earnings growth has been more like 5% in 9 months and more likely in the whole year also. But next year, earnings growth is more likely to be in double digits, let's say about 15 to 17%. So given the pickup in growth, and by that time, hopefully some of the situations around global uncertainty, trade wars, liquidity, also, etc., will get addressed. And that is also going to, aid the sentiments in the stock market. Just one more point I would like to put, Shailendra, is the currency. I think a lot of the selling, which was driven by FIIs, was also due to the weakness in the currency. So the currency has been, down by around 5.5% or so in the year, out of which around 3.5% or so has come in the last 3 months. So a sudden fall in the currency also creates a lot of scare. I think as these things stabilize, we would see sentiments improving.
My last two questions to you, Mr. Bansal. When you talk to corporates, what are they telling you in terms of their plans, in terms of their growth prospects, in terms of their demand consistency? And what are you telling your clients? What are they asking you? Are they worried? Do they want to withdraw money? Are they putting in fresh money? What's the general consensus in this spectrum?
Sure. So from corporates, what we understand is that yes, in pockets, there has been an impact on demand because of consumer slowdown, especially on the urban side. Rural side, there has been a pickup. But corporates are also hopeful that the pain on the urban side is unlikely to last for a long period of time, given the various measures that we've discussed have happened on the macro side. On government spending, there has been a pickup, so they believe that government activity levels they have seen a pickup in many pockets, and hopeful of project pipeline ordering, etc., picking up going forward as well. As far as investors are concerned, Shailendra, yes, the fall in the markets has impacted sentiments for sure. Investors are worried a lot today, and rightly so, because of the drawdowns that have been seen. Many of them, a few of them obviously would like to withdraw, but this is not the right time, is what we would like to suggest. And a few of the other ones are actually using this as an opportunity to put in more money to work. Generally, the case is that when the markets are falling because of the pain that is seen in the portfolio, the general sentiment or the mood could be to actually get out. But a few investors are actually using this as an opportunity to deploy money, staggering it over some time frame because of the uncertainty involved, and no one really knows how long this uncertainty is going to last. But perhaps we are not very far. The larger part of the pain perhaps is likely behind.
Sandeep ji, I don't know whether you have this, whether you've experienced this personally or not, but it is impossible to withdraw funds from a PMS entity. They never let you do it. या तो बहुत अच्छा बुल मार्केट चल रहा है, या तो इतना अच्छा टाइम है यहाँ पे और पैसा भेजिए. तो withdrawing money from PMS is very, very difficult. I have personally learned this the very hard way. Be that as it may, is 2025 a write-off in terms of indices? And where do you see the Nifty maybe by Diwali, by Christmas?
So, unfortunately, Shailendra, the markets don't follow any time frame or any events per se. I would like to believe that, as we've discussed, that a large part of the pain is already kind of reflected in stock prices. In fact, indices is one. If you look at individual stocks and portfolios, they could actually be very different. So many stocks have fallen quite a lot. And in this kind of a fall in the market, what happens is that there is collateral damage, there is correction across. It is not only that bad businesses or inflated stock prices correct. Investors just want to get out and they would like to sell across the board, and hence even good businesses come down. So rather than thinking about indices per se, what we would believe is that in the market out there, there are good opportunities which are available at attractive valuations in the current market environment with a good long-term outlook. And we believe that any investor who has that kind of an outlook will make money from these levels.
Right. With that, Sandip ji, we'll call it a day. Thank you so much for your time. And it's been a wonderful learning exercise in finding out what solid businesses are according to ASK investment managers, as also where you see money moving in and the state of play of the markets. Thank you so much for your time. Have a nice day.
Thank you so much for having me, Sharon.
This, ladies and gentlemen, was Mr. Sandip Bansal, Deputy CIO at ASK Investment Managers. Mr. Bansal oversees 30,000 crore rupees in PMS and AIF money, has a tilt towards large caps, is hopeful that 80-85% of the pain is behind us. He believes that fundamentally the Indian market is not facing a crisis. Of course, there is uncertainty because of geopolitical events, but primarily the pain is behind us and the currency has also stabilized. Thank you so much for watching us, ladies and gentlemen. Please continue with Business Today Television. There's a lot that's happening on the other side of the break. Good morning, ladies and gentlemen.